So let's look at a few basic facts associated with premiums, and then I'll go through some further examples of whether an option is in the money or out of the money. So we've established that the premium has those two components, time value, intrinsic value. Intrinsic value is always positive or zero. So if you're calculating intrinsic value, it will never be a negative number. Either it has intrinsic value or it doesn't. The time value, as we discussed on Friday, obviously depends on the number of days left until maturity of the contract, and it also depends on the underlying volatility. When we looked at the prices in the Wall Street Journal on Friday, we saw that if we had a particular strike price, so we looked across one of the rows where we chose a strike price, and then for the more distant delivery month, obviously for the same strike, the only difference between those two, the primary difference I should say, would be time. And the more distant the contract, the higher the premium, and that reflects the fact that it's picking up time value. But if we made a comparison between contracts, let's say we looked at the T-bond contract and perhaps the corn contract, and suppose there's a lot more volatility in treasury bonds than there is in corn at this point in time. So in a market where there's higher volatility, you would also expect to see a higher time value, everything else held equal, for the simple reason that the more volatile the underlying price, given that you have a certain time until expiry, there's always some probability that that option will move in the money. And the more volatile the underlying market, the greater the probability that it will move into the money. If corn is quite stable and we're looking at an option that's deep out of the money, let's suppose the difference between the futures and strike is 20 cents a bushel. It's deep out of the money. And if it's not a very volatile market, then there's, in all likelihood, a small probability that will move in the money. Compare that to the T-bonds. If it's a highly volatile market and it's deep out of the money, given the volatility, there's always a reasonable probability that it will move into the money. So those two factors essentially determine the time value. And we'll look at the important role of volatility when we talk about the Black-Scholes formula. So that's time value. Intrinsic value, as we said on the earlier slide, is simply the relationship between the strike and the futures price, and it depends whether you're talking about a call or a put. And the premium typically would never be less than the intrinsic value. In other words, even if time value were almost zero, well, it should reflect the intrinsic value. Otherwise, the market is not operating efficiently. So it's normally the minimum premium is the intrinsic value. So we'll look at a formula called the Black-Scholes model that helps us determine what a fair premium is. But let's just write down the facts that determine, the variables that determine time value, and we've already mentioned them. Obviously, time, volatility. Interest rates reflects the opportunity cost of money. It's a factor in the Black-Scholes formula, but is not as important as the other two. And then, of course, there's a supply and demand for the option. As I mentioned, options have been traded for 15 or 20 years, options on futures. Originally, when they came on the board, some of the premiums were very high because the market was thin, there wasn't a lot of trading activity, and the writers of the options were charging very high premiums. It's now much more competitive, and obviously the more writers that are willing to sell these options, the premiums will come down to a competitive level, something close to what would be predicted by the Black-Scholes formula. Okay, we've already talked about the intrinsic value, so I don't think we need to cover that ground again. Sometimes options are referred to as decaying assets for the simple reason that time value erodes as we approach expiry, and sometimes it erodes at an increasing rate. So if we're 12 months from expiry and it's a market where there's considerable volatility, then it might have a large time value. When you think of the writer of the option, if you're 12 months from expiry, the writer of the option has to assess the probability that that option is going to move into the money. And for most markets, that probability would likely be quite high. So therefore, the premium will also be high, reflecting a large time value. But of course, as we approach expiry, then the uncertainty with regard to what might happen is narrowed down. So if we're 12 months from expiry and the option is 20 cents out of the money, well then, even in the corn market, there's a good chance that that could move in the money. If we're 2 weeks from expiry and it's 20 cents out of the money, then there's a very high probability that it will stay out of the money. So essentially, that's a critical factor for the writer of the option, is that they're trying to assess the probability that this option will remain out of the money or move into the money. And later on, we'll talk about an important component of the option premium is called the delta factor, and I'll just mention it now. The delta factor measures the extent to which an option's premium moves with the underlying futures price. So if we have a corn contract, and let's suppose the futures price is $2 a bushel on the March contract, and suppose your strike is $2.20 a bushel, and it's a call option. So in other words, you'd buy the right to go long at $2.20. It's now at $2. So that option is out of the money. So if instead of buying futures, you decide to buy options, and you go ahead and you purchase that call option, and you wake up tomorrow and you open up the Wall Street Journal and you see that the corn market is up 5 cents. The futures prices are up 5 cents. Well, that doesn't mean that your option premium will move by 5 cents. In other words, the delta value for that particular option will likely be less than 0.5. It might be around 0.5, 0.4. So for a given percent change in the futures market, if it was 0.4, you'd have a 40% change in the options market. If it was a call option that was even deeper out of the money, let's suppose it was a $2.40 strike and the price is now $2, then even if the futures market moved up 5 cents, that option might change by 1 penny or not even. So there'd be a very small movement in the option. So if you have options that are deep out of the money and there's a high probability that they will stay out of the money, then their premium doesn't really move that closely with the futures price. Alternatively, if we had an option that was deep in the money, so you're buying a call with a 180 strike and it's now $2 futures, so there's a 20-cent intrinsic value, well then there's a very high probability that that option will stay in the money. So if there's a high probability that it will stay in the money, then its delta factor will be close to 1. It might even be 1. So in that case, when you got up in the morning and checked the Wall Street Journal and you saw that futures prices moved up by 5 cents a bushel, then that premium would also move by 5 cents a bushel because it's deep in the money and the delta factor is close to 1. So the writer of the option is really assessing this probability. Will it stay out of the money? If it will stay out of the money, then the delta factor is very low. And even if the price moves up, the writers don't necessarily ask for a higher premium because the probability that it will ever move into the money is very, very low. If it's at the money, then the delta factor is 0.5, which reflects the fact that if it's at the money, there's a 50% chance that it could move out of the money, a 50% chance that it could move in the money. We really don't know if it's at the money. So that's the delta factor. So you can interpret the delta factor as really being the probability that this option will stay in the money. So if it's deep in the money now, the delta is close to 1. 100% probability it will stay in the money. If it's at the money, delta is 0.5, 50-50 probability as to whether or not it will move in the money. If it's deep out of the money, the delta is very low, which means there's a very low probability that it will stay in the money. So the question is there a formula to calculate delta? Well, basically, you use historical price behavior. So you watch how the futures price has changed over the last X days, and you look at how the premium has responded to that, and that basically gives you your delta factor. But the delta will change, too, as we move through time. But if we looked at a particular option, a particular call option with a strike price, we just look at the premiums and the futures prices for the last 10 days, and we determine what the delta was, because it measures the extent to which the premium moves with the futures price. Okay. So that's more or less the basics of how options on futures work. We want to become more familiar with calculating the intrinsic value and determining whether or not an option's in the money or out of the money. And also we'll work with some payoff charts that will facilitate showing the outcome to holding either a call or put, and in fact hedging with calls and puts once we get to that point. So we'll be working with some graphs to show how the value of an option will change over time with a change in a given futures price. So here's a graph that says on the horizontal axis we have the futures price at expiry, and on the vertical axis we have the profit or loss. It's a 45-degree line, and this reflects the payoff. This is a payoff chart to the buyer of a futures contract, and it crosses the horizontal axis at the price where the contract was entered into. So if you buy a crude oil futures contract at $30 a barrel, that's where it crosses the horizontal axis. As you know, if the price goes up by $5 a barrel, then your profit will be $5 a barrel if it moves from 30 right up to 35. So that's pretty much how we show the payoff to a futures contract. It's a 45-degree line. If you're long, it's upward sloping. If you're short, it's downward sloping. Now we add a payoff chart to a call option with that. So this bottom kink line shows the payoff to the buyer of a call. So it has a flat spot that reflects the fact that if the price stays low, then it will be out of the money. So basically, what this chart shows, again, this is your profit or loss. It shows that your premium will shift down your expected payoff. So unlike in a futures contract where you don't pay a premium, in the case of an option, automatically you're behind the curve when you pay this premium. So if it's a crude oil contract, it's a $30 strike and the premium is $5, then that contract has to move into the money by $5 before you break even. So we'd show your payoff chart as this kink line, and it's kinked at the strike price. Right? So again, this is the futures price at expiry, and you're buying the right to go long at $30 a barrel. So if the price of oil was at $15 a barrel, well, you would not exercise that option, would you? As it approaches your strike, as it approaches $30, then it's moving towards being in the money, and to the right of the strike price, then it's in the money, and once it hits the strike, which is $30, then your return starts to move towards the positive territory. But as I said, it would have to move by $5 before you even break even. So if this happened to be $30 as your strike price, and your premium was $5 a barrel, then the break-even point would be 35 on the underlying futures price, right?
So,
Yes.
say an option is not worth, well, I mean, you have this option, right, and it doesn't go up by $5. So if you don't exercise your option,
You do not exercise it.
what happens? Do you lose something?
Okay, so the question is, suppose the option is not exercised. So why would you not exercise the option?
No, not why, because I understand you're going to lose value.
Okay, but I'm just asking so everybody's on the same page, okay? So you tell me, why wouldn't you exercise it?
Because you wouldn't want to lose money, or you wouldn't want to lose the actual value, because your premium is going to cost you.
If the price of the contract is more or less than what you have your option for.
Less than, and what's that term called? Strike price, out of the money, right. Yeah, thank you. So if, you were right, I'm just looking for the exact terminology. So the strike price is $30. You pay $5 for this. And let's suppose the futures is at 25 and it just stays there, doesn't change. Well, you're buying the right to go long at 30. So you really have no interest in being long at $30 if the price is now $25. Because if you exercised it and reverse it, you lose $5, right? So that option is out of the money. And if you hold that option until expiry, it stays out of the money, never moves into the money, then it's basically worthless. And that's the option that you burn in your fireplace at Thanksgiving, right? So it stays out of the money. So you're to the left over here. And then the question was, so you're out of the money. So then the question was, well, what happens? Well, nothing really. I mean, you've paid the $5 up front to the writer of the option, so they have the $5. They hope that it stays out of the money. The reason they only charged you $5 and not something higher was they thought there was a small probability that this option would move into the money anyway. So if it's the futures price stays low on the left-hand side, then it expires worthless, and you lose $5 and the writer gains $5. Did you have a question? No. Okay. Does that answer your question? Yeah. Okay, are you with me in terms of this graph here? Because they will get more complicated. We'll start adding some of these lines together when we start talking about hedging. And also these payoff charts are something that I will ask you to draw either on the midterm or the final. We'll give you some data, some information, and I'll ask you to draw some payoff charts. Excuse me. So here's a payoff chart to the buyer of a put option. So we could set this up the same way. Let's say that the strike price is $30. Whoops. Let's say it's $30. Again, this is crude oil. So in this case, if the futures price is high, then it's out of the money, right? And if it's low, then it's in the money. It's in the money. And so you're buying the right to go short at $30, and you will exercise that right if the futures price falls below 30, because you want to sell at 30 and buy at a lower price. So you want this option to move into the money. So the payoff chart is shifted below the horizontal axis by the amount of the premium. And again, we could set this at some arbitrary level. Let's say it's $5. So you pay your $5. If it hits 30, now it's at the money. And if it goes below 30, then it's in the money. If it goes down to $25, then you break even. So this point we call your break-even price. That's your break-even price. So you can see that once we get by the kink in this payoff chart, then it also rises at a 45-degree angle, but it's shifted over from the payoff chart to the seller of a futures contract by the amount of the premium. So the solid 45-degree line is the payoff chart to the seller of a futures contract. If you sell a futures contract and the price is now $30, the price falls by $5, you make a $5 profit. You know that. So it's a 45-degree line. If you buy a put option with a strike of 30, well, the price has to fall to 25 before you break even. So right away you can see, hopefully you can see from this graph, that speculating with options may not be the ideal way to invest in these markets because you have to pay this premium. There's no free lunch, right? You're paying the premium. So if you're paying the premium of $5, and even if you're right and the price falls and it goes from 30 down to 25, well, all you do is get your premium back. You don't make any money. Whereas if you had simply sold a futures contract and the price fell by $5, well, you'd make $5,000 on one contract because there's no premium. So obviously the advantage of buying a put is that if you were wrong and the market moves up, so the futures price moves up and it goes to $40, well, the most you lose is your premium, okay? Shown by the payoff chart. That's that flat spot. You can't lose any more than the $5, and it doesn't matter what happens to the price. So if the price goes up to 40, you still only lose $5. Of course, with a futures contract, you know that your losses pile up as that price rises, because then you start to move down that 45-degree line. So of course the advantage of buying a put instead of selling the futures contract is that your losses are limited. But on the other hand, if the market moves in the direction that you're predicting, it will take a certain move just to get your premium back before you actually start pocketing money. So between the 30 and the 25, you're earning the premium back, but you don't actually break even until it hits that yellow horizontal axis. Okay? Yes?
Is there a percentage of the, say, out of all the trades, how many of the option buyers make money, how many lose?
I don't know the answer to that question. The question was, of the option buyers out there, how many make money and how many lose money? I imagine the statistics are very close to what we find in the futures market. In the futures market, of all the traders, speculators, about 80% lose money. Okay, 20% make money. So there are a lot of small traders that will go in the market and get beaten up, and you don't hear from them again for a decade, right? Then they come back in the market again. So there are lots of small speculators who will trade for a while, lose money, and then exit. So the 20% tend to be professional traders or people who have been trading for years, etc. So I guess in the options market, the ratios are very similar. Okay, so let's start putting some numbers on some of these examples. This is what we'll be doing when I ask you to draw the payoff charts. And here's a very simple example. So let's go to the corn pit, okay? And we've got a corn put, which is the option to go short. And the reason you would buy such an option is if you expected prices to fall, right? If you expect prices to rise, you buy a call. So you expect prices to fall. And let's suppose that you buy a put that has a strike of $2.50, and the premium is 13 3/4 cents. So then the question is, let's draw our payoff chart. So on the horizontal axis, we have the futures price. We have the strike price on this option, which is $2.50, and that's always the point where the payoff chart will be kinked. It will always be kinked at the payoff chart. excuse me, it will always be kinked at the strike price. So your payoff is this orange line that is shifted down below the horizontal axis by the amount of the premium. So up front you're paying 13 3/4 cents on 5,000 bushels. That's a total of $687. So that's what it's costing you for this option. If the price falls to $2.36, then you get your premium back. So that illustrates the example I was just referring to. It would actually take a significant fall. So this premium is quite high. It would take a significant fall in the price down to $2.36 before you break even. So if it falls to $2.36, we're now in the money. We're in the money once it crosses $2.50. And if it fell down to $2.26 down here somewhere, then we'd read the profits off this line, which would be, from this point on, a 45-degree line. So if it fell to $2.26, then you'd make 10 cents a bushel. So in order for you to earn a profit of 10 cents a bushel, let's suppose it's at the money today, then it would have to fall by 23 cents a bushel, which is a significant change. Yes?
Do you start earning a profit as soon as it starts falling below the $2.36? If it's only 1 penny?
Yes, you do. Once it moves in the money, you start getting your premium back, right? And so it moves into the money at this point, but this line stays below the zero axis, indicating that you haven't recouped your full premium. So when it hits the 236, you're right. Then that's at that point you get your premium back. Anything beyond that is profit. Here's another example. Okay, and I'll ask you probably a couple of these on the midterm next week, where again I'll just give you the Wall Street Journal and I'll ask you to draw one of these charts. So you'll be given the prices, and you just draw a payoff chart for either a put or a call. So let's look at the yen market, excuse me. And I will just indicate what your expectations are, and then you'll have to decide whether you buy a put or buy a call. And I probably won't ask you to draw the payoff for the writer of an option until later. But in any case, let's suppose you think the US dollar is going to increase. And then you go into the yen options market and you take a position. So you think the dollar is going to increase in value. So in that case, you would buy a put, because remember, the yen is priced in dollars per yen. So if the dollar increases in value, then the dollar per yen figure will fall, right? So each yen will cost you fewer dollars. That's why you'd buy a put. And let's say the strike price is, let's see, 0.01035. It gets a little tricky with the yen because there's so many decimal places. So that's the strike price. Let's suppose that the premium is 1.65 cents per 100 yen. And recall from when we looked at the Wall Street Journal on Friday, that results in a few decimal places. It's 1.65 cents per 100 yen. So I'll give you the Wall Street Journal. That's how it's reported, and you must translate that into a dollar amount. So that's equivalent to $0.000165 per yen. You multiply it by the contract size, and that gives you your total premium, just over $2,000. And let's say the underlying futures price is at 0.0103. So now you draw your payoff chart. Well, you know that it's a put option, right? So the payoff is going to be in this direction, because in a falling market you will make a profit. In a rising market, you're just going to lose your premium. It's kinked at the strike price, right? And then you calculate your break-even price, which is the difference between the strike and the premium. So you subtract the premium from the strike price, and the market must fall by that amount. It must fall to 0.01018 in order for you to break even. And if it continues below that price, well, then you'll make a profit above and beyond what you paid for the premium. So that's your break-even point. So it's a matter of becoming comfortable with the way these prices are recorded. Okay, all the payoff charts look very similar, but it's a matter of looking at the yen or the bond market and being able to translate what you see in the Wall Street Journal to the payoff chart. So here's an example from T-bonds. Okay, so we'll just run through these. So again, I tell you that you think interest rates are going to fall, and you know that if interest rates fall, bonds rise, right? We know that, which means that you need to buy a call option. And let's suppose that the strike price is 100 even, so it's 100% of par. And let's suppose the March call is priced at 141.64. Remember that the options are in 64ths and the futures are in 30 seconds. So that's your premium, 1-41. And each 64th is worth $15.62. Remember, you divide the 31.25 in half, because each 32nd is worth 31.25. Each 64th is 15.62, because if you multiply 15.62 by 64, you'll get $1,000. So if the premium is 1-41, you know that it's somewhere between $1,000 and $2,000, right? And it turns out that it's $1,640. That's your total premium. The underlying March futures price is at 99.18, and now you draw your payoff chart and you show where it's out of the money and where it's in the money. So we have our strike price is 100. Our premium is $1,640. Where's the break-even price? Now this is where you have to remember that the futures are in 30 seconds. So the horizontal axis is futures, right? This is the underlying futures price. So your strike is 100. You paid a premium of 1-41.64. So if you divide that 41 in half, it's just around 20, it's 20 and a bit, 30 seconds. So that's why I say the break-even price is at 101.20, 30 seconds. Because this is in 30 seconds. Obviously, it's out of the money to the left of the strike price, down here, and it's in the money to the right of the strike price. So we say that it's in the money even if you have not hit the break-even price. Yes?
Can you explain the break-even price again, how you got the
Sure.
Yeah, I was going to ask if maybe you can do the calculation on the board so we can see the 64 to 1-20.
Yep. So the premium is 1-41, or 1-41.64. Right? That's how the options are priced. They're priced in 64ths. And each 64th is worth 15.62. Do you recall when we discussed that? Do you know why that is? Right. Each 32nd, you know, is 31.25, right? So each 64th equals 15.62. And if you recall when we discussed T-bond futures, they're priced in 30 seconds. Each 32nd is worth 31.25 because 31.25 times 32 is $1,000, right? And the face value is 100,000 on these, and our pricing is percent of par. So with 64ths, it's just a matter of dividing that 31.25 in half. So that gives us 15.62. So our total premium then is 1,000, right, plus 41 times 15.62, right? And that's 16.40. So that's our total premium. And then your question was, well, how do you arrive at the break-even price? Well, the break-even price is in 30 seconds because we're looking at the underlying futures price. So this is always in 30 seconds. So 1 and 20 30 seconds is approximately equal to 141/64, right? I've just rounded this off when I've written 101-20. So that's where I come up with the break-even price. So in other words, the futures price must get to 101 in 20-30 seconds before you recoup your $640. Did that answer your questions, or?
Yes, I mean, I just don't know how, like, I was, know that was supposed to go to 101.20. Like, I see how 101.20 equals 1 over 41.
Yeah. Well, if suppose I said the premium was 1 and 10/64 instead of 1 and 41. So that's your premium. So what would your break-even price be then?
Whatever that transfers into the future price.
Right? So it's 1 and something over 32, right? Okay.
So that doesn't have anything to do with the strike price, or is that? Oh, they're all like.
It does. It's the break-even price, in this case, is equal to the strike plus the premium. Okay? Yes? Right now, yeah. Yeah. At this point, it's just a little bit of additional information. I'm not actually showing it up here. Other than you can tell whether it's out of the money or in the money. So if the underlying futures price is at 99.18, then is this option out of the money or in the money? Out, yeah. Okay, how about this half of the room? Out, yes. How about this half of the room? Do you follow the example? Okay. So I will give you an example from one of these I'm using in class, yen or bonds or something like that, okay? Okay, we did some of this on Friday, and let me just go back to it. Does this green show up, the IM here? In the money, yeah. So here's a table of options prices from the cotton market. Cotton is 50,000 pounds, and the prices are in cents per pound. The underlying futures prices are down here at the bottom. And then I just ask you to identify which options are in the money and which options are out of the money. So first of all, we look at the March call, right? And if the strike price is 54 and the futures price is 56.55, well, could you make a positive return if you exercise that? And the answer is yes, because you go long at 54. It's now 56.55, right? So you'd sell at 56.55. Ditto for 55-cent strike and a 56-cent strike, you would still make a small return. If you go to 57, well, then you're going long at 57. March futures is now at 56.55, so that's out of the money. So anything inside these orange lines are in the money. If you go over to the May call, you'll see that May futures are 57.35. So even though the March call with a 57 strike is out of the money. The May call with 57 strike is in the money because March is 57.35. So if you went long at 57, you could sell at 57.35 and earn a small return. And similarly for July, the July futures are at just above 58 cents, right? 58.1. So there, even the 58-cent strike is in the money. So those inside the lines are in the money. If we did the same thing for the puts, well, it's no big surprise that for the puts, it'll be just the opposite in terms of which options are in the money. It'll be the more expensive options that are in the money. Usually if I'm asking you for which options are in the money and out of the money, it makes sense that when I said more expensive, I was referring to the strike price. It makes sense that for call options, those with low strike prices will tend to be in the money, right? So you can pretty much start up at the top. With put options, those with high strike prices will tend to be in the money, which means that for puts, those with high strike prices will tend to have higher premiums, because if you're in the money, you're going to have a higher premium because there's time and intrinsic value. So it's no big surprise that if we come down this column, the premiums get higher because we're going from out of the money into the money. And this one is deeper in the money than this one, so it has a higher premium, and similarly here, right? And with calls, it's just the opposite. If we're going from a high strike to a low strike, the premiums ought to rise because you go to a low strike price, that option is going to be deep in the money, okay? If you look at, we look at July futures of 58 cents, strike of 54, that's deep in the money. So it has a high premium of 6.6 cents a pound. So you've got the high premiums on top in the case of calls and the high premiums on the bottom in the case of puts. So you can see that there's some kind of relationship here. And I'll show you on Wednesday that if we pick a March call with a 56 strike and a March put with a 56 strike, there is a relationship between those two options in terms of the prices. Yes? Did you have a question? Oh, okay. Keep thinking you're raising your hand. Yes?
So do the numbers that are circled, do those numbers actually have any significance?
Those are premiums.
But in order to decide what's in the money, do we need to look at the actual numbers?
No.
Based on the futures price or strike?
Correct. That's all I was comparing. I was looking at the futures price and the strike. And you know that with calls, if the futures is above the strike, then it's in the money. And with puts, it's just the reverse. Okay, I'll see you Wednesday.